I was about 22 years old, and I had just graduated from college about 3 weeks before I landed at Kai Tak Airport, ready to start my new job at CNN. I remember it pretty vividly because I got off the plane in the middle of the night, and it was so hot. It was incredibly humid. It was like walking into a wall of humidity. And it was incredibly crowded for about 2:30 in the morning. And the taxi line was insanely long, and I absolutely loved it. I fell in love at that moment with Hong Kong. I was there because I had had a very lucky break, and I had been interning every summer while I was a student in college at Turner Broadcasting. Turner Broadcasting at that time was still relatively small. It was on the map, but it was still a relatively small and still independent organization, not yet part of Time Warner. I had interned every summer and was hoping to get a job when I got out of college, and was hoping very much to get a job overseas in the newly established international division of Turner Broadcasting. So every summer I was working on the advertising, sales, and marketing and distribution side of the business, doing odd jobs, fetching coffee for people, doing whatever anyone wanted. And I landed a job in London, and I was extremely excited to go. I was packing for that trip and for that move a couple of weeks after I graduated from college, and I got a phone call saying, hey, we know you're going to London, and we know you're excited about that, and you still can if you want, but a little bit of a last-minute change. Ted has just decided to set up a budget for a Hong Kong office. Would you like to go? And I said yes. And so about a week after that, I landed at Kai Tak Airport. That was probably the best decision I ever made. I ended up working and living in Asia, in Hong Kong, in Singapore, and in Beijing for the last 21 years. And today, I'm not here to tell anyone how to be an entrepreneur. There's no one-size-fits-all for that. And I'm not here to tell anyone specifically about what's going on in China. There are far better policy experts than I probably here on campus. What I am aiming to do over the course of this talk is just give you an idea of my own experience, what I went through over the past couple of decades of living and working in Hong Kong and China, both, as Clay said, for a large multinational media organization, and then also for my own businesses. And hopefully that will give you all a sense of what I went through and what my story is, and maybe how it applies to doing business today. And I'm happy to then take any questions. Back to that first time off the plane at Kai Tak, I was completely underqualified. They probably shouldn't have hired me and sent me to Hong Kong at 22, knowing absolutely nothing. But I was thrilled to be there all the same. And there were a couple of us that were charged with setting up the offices for the business side of Turner Broadcasting, mainly advertising, sales, distribution, marketing, satellites, and all of the infrastructure setups for building a business in Asia. A small handful of us on the first day, and within about 2 years, we had about 250 people on the ground. Satellite TV was exploding all over the world at that time and growing like crazy. And within about a year and a half, we had launched a regional feed for CNN, which was specific to Asia. At that time, O.J. Simpson was all over the news. And I remember having so many calls back to Atlanta at that time saying, I know this is a really big story in America, but nobody cares over here. We got to do something about this. And after more and more of us were complaining in the same way, we finally started to create budgets and structures which would then allow us to split off a separate feed for CNN Asia, which was more relevant to that part of the world. We also launched Cartoon Network, which was really exciting, building a business around the region for kids in 12 different languages, and as localized as we possibly could make it at that point in time. I was lucky enough in that the business was growing at such a steady clip that I was then asked to move to Singapore to set up a separate regional office which would serve Southeast Asia, across to India, and down to Australia. So I lived in Singapore for 4 years, building an ad sales business and distribution and marketing for those TV networks in that part of the world. And I was having a ball doing that. I then got a call because not long before that, Turner had been acquired by Time Warner, and I started working on some of the bigger corporate initiatives across the two newly combined companies. So I then got a call asking if I would move back to Hong Kong and move to Time Inc., the publishing arm of the company. So I found myself in Hong Kong, back in Hong Kong at about 28, and I was president of a regional magazine called Asia Week, which some of you may recall, which Time Inc. had owned for about 15 years. And it was a break-even business at best. It had a great place from an editorial standpoint in the region, but had never really been a profit center for the company. So the job I found myself in after having left a really fast-growing, very highly scalable TV business was a marginal magazine business, which was a pan-regional English language magazine in a very, very tough marketplace in Asia where pan-regional English language magazines were not doing very well. So it was a turnaround job and a much different kind of role than I had ever been in. We set about fixing it and revamping the editorial product. My team and I worked on various cost-cutting initiatives, but we were too late. And we decided after a couple of years of plugging away at trying to create a more sustainable, more profitable business that pan-regional English language magazines were dead. And we knew that because our closest competitor, the Far Eastern Economic Review, which a lot of you will also know, went under just before we decided to close our business. So I was about 30 at the time and had to lay off an entire staff, most of whom were older than me and most of whom had families, and it was awful. Later on, I realized what a great and valuable experience that whole process was for being an entrepreneur and for making tough decisions, but at the time, it sucked. It was pretty bad. I then went on to be Senior Vice President of Time Inc. in Asia, running the businesses of Time Magazine and Fortune Magazine in that part of the world. Much more established businesses. Both of them had been around the region for about 50 years. And at that time is when AOL came into the mix. AOL and Time Warner had just merged. It was the early 2000s. Everything looked great. All was exciting. Every graph and bar chart was pointing up and to the right. And life looked pretty terrific. Our bosses from New York, Jerry Levin and Steve Case, were very intent on building Time Warner, or the newly created AOL Time Warner, largely through acquisitions around the world. International was going to be a big part of that, and China was certainly a very, very big, important piece of that. So we as a company started looking at pretty large deals in China, and we had to look at large deals because when you're a company of that size, doing a handful of small deals just doesn't really move the needle. Problem was, at that time, and I think even still today, there aren't a lot of large deals to be done in the media space in China. We'll get to the regulatory issues in a moment, but because of the landscape on the media front in China, it's very hard to find large acquisition targets, especially when you are a multinational company like Time Warner, which doesn't necessarily have the biggest welcome in a place like China. So we had no shortage of deal flow. We were looking at a lot of interesting things. We did a couple of joint venture deals, one of them with Lenovo, another one with a large TV operator in China, but nothing that really moved the needle. That's when I caught the bug. And myself, I had been looking at a lot of opportunities, a lot of interesting deals in China, a lot of interesting companies in the media and advertising space. What I realized was that most of those were in the smaller, maybe $20 to $40 million enterprise value size. Some of these were very small regional companies or even city-level companies that had either a lot of traction with a large number of advertisers or were delivering demographics really efficiently. And at that time especially, there was really no way, if you were an advertiser in China, to buy demographics all across China. If you were Lenovo or Haier or a multinational like Samsung or IBM or Coca-Cola, you had to go and buy media and buy advertising in multiple cities across the country, and that was very inefficient. So a couple of friends of mine, two people who later became my co-founders in the business, started tossing around ideas, started talking a lot about setting up a new company. We talked to the regulators quite a bit. Those regulators I had gotten to know really well while I was at Time Warner, usually asking forgiveness for things that we had done at Time Warner that may have upset the authorities. The regulators in China certainly pay attention to media coverage around the world. They're very sensitive, obviously. Some of you may be journalists from China. You know what I mean. And we would often find ourselves at Time Warner in a situation where even though a story or an article or a cover had run on some of our media outside of China, maybe even in the US or Latin America, quite far away, an article slipped through on Tiananmen Square or Falun Gong or Tibet, and lo and behold, our Cartoon Network endeavors in China might be put on hold. So it was challenging. I remember speaking to the regulators about opportunities for a new type of business, and one which had a Chinese sensibility, one which was completely independent, small, a startup, which would be tasked with rolling up and combining smaller media organizations from across China into one bigger umbrella so that advertisers could buy demographics across the country more efficiently. So I left Time Warner, and that's what my co-founders and I set out to do. We started by buying a small publishing company based in Beijing, which at the time had one magazine. It was a magazine called Popular Science, which was under license, and many of you who grew up here in the US would remember Popular Science, which continues to exist today and is one of the oldest magazines in the United States. It had been licensed by a really creative and smart team of executives in Beijing who had built it into a profitable business in China, in Chinese language. So we saw a lot of potential in that group of people, in the editorial teams that they had put together, and in the advertising sales distribution that they had. We acquired the company for a very small amount of money and some shares in our new company, and we set out to build a bigger media business. We stuck to publishing, and we started to acquire homegrown Chinese titles, and also to launch Western titles in Chinese language adapted for China. And we did it really fast. We were really lucky in that we hit the timing quite right. Publishing was really coming into its own in China. The regulatory environment was pretty favorable towards Western publishing content at that time. So there was a big proliferation of magazines happening on the newsstands across the country. We did a deal first with Top Gear magazine, which is a BBC title based on the automotive space. There's a TV show attached to that, and we licensed the rights of that as well, and launched a Chinese version of that, which ended up doing quite well and relatively quickly. So we were confident, and we were really excited, and we started to license more niche titles from the UK and from the US. We did a joint venture with a very large Hong Kong family-owned publishing company called Ming Pao, which some of you may know, Ming Bo. With them, we combined our China operations with their Hong Kong operations, which had a lot of very successful, very profitable titles. And then we just kept launching more and more. That got us to Rolling Stone, where we did a deal with Rolling Stone magazine directly with Jan Wenner, who's the legendary founder of Rolling Stone, and was very excited about the magazine having a possible launch in China. We were too also very excited, and managed to build a team around starting the magazine. Brought in editors, all Chinese, all very local, great backgrounds from MTV, from Channel V, which is another music channel in China, and had a great product mocked up. We made no bones about it that we wanted to be extremely commercial, that we had no politics attached to the magazine, even though there is still a bit of an aura about the brand of Rolling Stone being one that pushes the envelope on the editorial side. That was not what we intended to do, and we were very upfront with the regulators and had a very open, healthy dialogue with them. I remember even going into a meeting with the regulators and dummy copies, and I put red pens out on the table just so that everybody could circle any content that they didn't like, so that we'd make sure we got it right. And I think we did. We had a great magazine launch. We sold about 130 copies on the newsstand in 24 hours, which is pretty good in the newsstand. Oh, you have it? That is a real... How did you get this? So, this is great. So this is our first launch copy. We spent a lot of time. Thank you for bringing this. We spent a lot of time launching this, and wow, this is bringing back memories. Thank you. I'll give it back to you, though. So this was a fantastic success when we launched it. We sold out, as I mentioned, the first weekend's prints and had to go to reprint, which was great. The one thing we didn't expect was that while we were not giving any press interviews, we know how business is done in China. Usually the nail that sticks up is the nail that gets hammered down. So we were very, very careful about not over-publicizing this and about just seeing what happened when we launched it. We were pleased with the results. What we couldn't control is the bloggers who liked it too, and who were blogging about it and talking about it and chatting about it. And that got to the larger journalist community, and our fellow colleagues in the journalism community started to write about it. So first there was an article in the FT talking about Rolling Stone launching in China, and is this a turning point for China? And then, much to our dismay and fear, the Wall Street Journal picked up an article and ran on the front page of the marketplace section here in the US, a headline, something to the tune of American counterculture magazine launches in China. Is China opening up? Question mark. We knew we would get a phone call after that, and we did. And it was a very nice phone call, very polite, from our friends at the regulator, who said, "What's all this coverage you guys are getting? We don't like it. Please make it stop." And so, you know, we were certainly very open about the fact that we had granted no interviews and nobody was quoted in those articles. But we couldn't make it stop. And there was more and more talk about this magazine. The regulators are smart. This was 2006. So we had certainly an open dialogue going with the regulators. They were very professional, full credit to them. They had no problems with the magazine content at all. They just didn't like the press, and fair enough. We had a much bigger business at stake, and we had much bigger plans. And so after about a year of really trying to figure every strategy to keep this magazine going, we ended up closing its doors and moving on. At that point, the group that we started, the magazine company that we started called One Media Group, or Wanhua Meiti, was already a public company listed in Hong Kong. So we were certainly very sensitive to the future of that business and to future prospects of being able to launch more magazines, to acquire more businesses, and to continue expanding throughout China. So we moved on. And that's about the time that my same co-founders and I, after One Media went public, started focusing on other businesses in the media space. We had launched a company called Redgate Media Group, which basically we positioned as everything else. So publishing was our public company, Wanhua Meiti, or One Media Group, and Redgate Media was everything else. And so we set out to start acquiring and building businesses in the television advertising sales space, in the outdoor advertising and out-of-home media space, in the PR and below-the-line advertising space, and in the mobile advertising business, which was starting to really take hold. A lot of SMS marketing businesses and a lot of interactive marketing companies starting to pop up that we liked. So with that, we started building. We started acquiring outdoor advertising companies and also concessions, and built an outdoor business that spanned about 42 cities, if I'm not mistaken, with, I think at the height of our growth, around 20,000 displays around the country, such that advertisers could buy pretty large geographies at one time in outdoor. And that, I would explain that a bit in that not a lot of people think about outdoor advertising as media, but of course it is. We liked it because it offered advertisers yet another solution, and outdoor media has proven to be very effective in China. But also we liked it because outdoor advertising is a really good cash flow business. The way outdoor advertising works is that you usually get your cash payment up in advance from an advertiser, as opposed to most other media businesses where you get it when you get it. And so we liked outdoor for that reason. It was able to fuel the growth of some of our other businesses. There were other big players in the market like Focus Media, which was doing and still is doing digital displays. The marketplace got really hot in the digital display area, and we stayed away from it because it was really high capital expenditure, and building and maintaining those digital displays was always very costly. So we stayed away from it until Focus and some of their other subsidiaries had a few troubles and blow-ups, and then we went in and bought those concessions where we didn't have to build them, we could just take them and operate them. So we tried to be as opportunistic as we could in running the business. We built a radio business which consolidated the content of about 250 stations across the country and had a very wide reach. We streamed all of that content into digital radio, and we're working with Tencent, which is one of the larger internet companies in China, to stream some of that content. And then we were also building a TV advertising sales business where we partnered with city-level and terrestrial-level TV stations. In China, you're not allowed to own stations as a non-government entity. Doesn't matter whether you're a foreigner or a domestic national. You can't own a TV station in China. But you can own an advertising sales company which manages and retains all of the revenues from those companies. So we set about consolidating those opportunities so that we could give advertisers reach into television advertising. And that was a very lucrative business for us. We got a bit aggressive, and we got very confident because as our business was growing, we were on paper looking better and better from a P&L standpoint. And the markets themselves, the capital markets, were also looking better and better for companies like ours, which were high growth China companies in the media and advertising space. So there were a few public offerings, starting with Focus Media, then with some of the internet companies that went out, that started us thinking maybe we should be public too, and maybe this time we should do it in the US. So we set about filing for an offering in the US, which was to be a Nasdaq offering. We filed for that in August of 2008. Does anyone remember 2008? And about 2 weeks after we filed, oh, and I should say, when you file for an IPO, some of you probably already know this very well, better than I, but when you file for an IPO, you've already done a lot of work up to that point. You've audited to whatever accounting standards are the standards of the venue you're going public in. So in this case, US GAAP accounting standards. We were on Hong Kong GAAP accounting standards, so it was a pretty big challenge. And you do a lot of legal work, and you write a prospectus, and you bring your banks on board. Our underwriter, we were thrilled about, was Citigroup. Citigroup was not Lehman, but those of you who recall 2008 and beyond remember that Citigroup didn't look so hot during that time period. So after we filed in early August, we got a call from someone saying, we got to stop working on this project. And in fact, pretty much the whole team you've been working with at Citi is no longer there. And as an entrepreneur, nobody really gives you a handbook on what to do when you have to stop your IPO process because the global markets are in a financial meltdown. I might try to write that book someday, but I don't know that I necessarily know a lot more now than I did then. It was hard, and it was pretty tough times, and we decided that we just had to focus on the business and get through it. What's really interesting, at least what has been interesting for me, is that as you grow a business as an entrepreneur and as the business starts to scale, as a founder, one of the things that almost inevitably happens is you get further and further away from the actual day-to-day business. And I certainly felt that, where I could have just as well been a banker at that point, where I was working on the capital market side of trying to get the company public, trying to find exits for our investors, trying to appease the subsidiary companies that we had bought, in many cases, we'd bought them with structures of share swaps. So maybe a little bit of cash, but mostly shares, which is really a promise that you're going to go public at some point, or at least find them an exit. So there was pressure from investors, there was pressure from subsidiaries, and there was pressure just pretty much all around. And did I mention that we were in the middle of the global economic crisis? So that was really tough. We decided we'd focus on the business. We did. We sold off businesses that were marginal, that we didn't think could really weather the storm with us. We begged investors for a little bit of bridge capital so that we could keep the lights on and keep the payroll going. We didn't know if we would get that support. We got it, and we got just enough to sort of get us through. But from a period of about 2009 until 2012 or so, we were intently focused on getting that business public. We ended up getting the business public in Hong Kong in late 2012. And you know, there's several versions of the story that I can tell, and I usually, it depends on which audience I'm talking to. When you're with sort of the VC crowd, you have to always put the best spin on everything, and oh, it was great, and we rang the bell, and it was so much fun, and it wasn't that great, actually. The first go-around was terrific. The first IPO we had was great. The second one was kind of bittersweet because we'd been through so much. The company had been through so much, and we built it to a point where it was very sizable and very attractive in 2008 and 2009. By around 2012, it looked still okay, but time had really passed. Other businesses were looking really attractive as well. The IPO market hadn't really come back, and when we finally got it public, it was just a big sigh of relief. And we were tired. The business is still running today. There's still a lot of outdoor signage around the country. Our partners are still running their TV ad sales businesses. For me, I took away so much from that experience. It was so interesting building a company via acquisition in a market like China. Every time we did deals, we were working with the regulators to make sure they were structured properly. Legal was probably the biggest line item on our P&L as a cost center. More often than not, even though we were acquiring companies from smart, very successful entrepreneurs, we felt like we weren't really in control of our businesses. As many of you know, doing business in China is tough. Doing business with entrepreneurs in China is really tough. And buying businesses from entrepreneurs in China is nearly impossible, because even when you've bought a business, you haven't really bought it, and you certainly don't really control it. So we were constantly herding cats in a way to make sure that the businesses were reporting on time, that we could hit our audit deadlines, and so that we could really make good on the expectations of the capital markets or on our investors for reporting. There were certain times where we were in negotiating periods with subsidiary companies for one thing or another, and it was audit time towards the end of the year, and we'd get a phone call from our auditor saying, hey, we've been locked out of the office of your subsidiary. We're not allowed to go in. And that was just the start of another negotiation with our subsidiary company to get us in and allow us to audit the business another year, so that we could all stay together and be one big happy family. So running a business in China like that is really tough. When we exited in 2012, I had already started looking at a lot of angel investments, and over the course of my being an entrepreneur in China, I had made some small angel investments in some Chinese startup companies and had looked at a few companies here in the US. and that had always been something of interest to me. So as I started exiting the company in Hong Kong, I started looking towards the US over the last couple of years. And given the resets that we've seen in the capital markets since 2009, personally, I started becoming extremely bullish on the US and extremely bullish on the technology sector in the US, specifically where content and media and technology are colliding and overlapping at this point. So I started gravitating towards Los Angeles and have teamed up with a small seed stage venture capital group based here in Santa Monica called Mucker Capital, working with early stage, seed stage entrepreneurs and startups, helping them build their business. For me, just segueing from the China experience to here, I've found that I've taken away a lot of really valuable lessons in building businesses. As I alluded to before, I don't think there's a one-size-fits-all for entrepreneurs. So there's no one who can get up and tell anyone else how to be an entrepreneur. I think there's an entrepreneurial spirit for sure, and some people have that in spades, some people don't. But there's no real roadmap for how to do it. These days when I work with early stage companies, at least I'd like to help them not make the same mistakes that I did as I built my companies. I'd rather just help them make new mistakes and take shortcuts wherever possible towards success and towards scaling their business and towards getting to market. So I found that while I can work with a pretty broad array of businesses, some of which I have very little experience, they're very tech-based companies. Some of them are not media companies, but a lot of early stage issues are similar issues, whether you're in Santa Monica or Beijing or Hong Kong or anywhere else for that matter. So it's been really fun for me.